For tonight's presentation, we're going to follow the following format. I'm going to be speaking for about half of it. Don is going to speak for about half of it as well. Topically, we're going to begin with a discussion of some of the main themes and drivers in the currency markets in 2007. We're going to focus primarily on the U.S. Canadian dollar currency pair. In terms of the main themes for the United States this year, and this one has come to the forefront very recently, we're going to be spending some time talking about the subprime and credit crunch that came out of that, mostly back in August and late August, early September. For Canada, we've identified two primary drivers, commodity prices and mergers and acquisitions. We're going to be talking about that in detail. For both the U.S. and Canada, we'll also highlight some key economic fundamentals, some of the performance indicators that we see there. After that, our discussion is going to turn to a high-level view of the currency markets in general. We'll be looking at a real bird's-eye view at some of the trends that have been emerging in the currency markets. We're going to take a look at the volatility that we've experienced in the last couple of years, the last few years especially. We're then going to zone in specifically on the U.S. dollar, Canadian dollar currency pair. Our real objective here is to kind of take a look at where we are now, which is the Canadian dollar has managed to reach parity. We're going to try to explain some of the fundamental reasons, some of the reasons why the Canadian dollar is currently at parity against the U.S. dollar. And we'll talk a little bit about some of the challenges in the currency market that are faced by the Canadian dollar, its likelihood of continuing to trade at these levels, and the risks and the things that are going to happen for us to continue to trade at the levels that we're currently at now as we look ahead into the balance of 2007 and into 2008. This should wrap up, I was going to say originally around 7:15. I'm not sure if we're running a little bit late now, but around that time we're going to have a break for dinner. And I guess around 8 o'clock or maybe shortly thereafter, it'll be my pleasure to turn it over to Don Lloyd. Don is going to talk about a few different things. He's going to talk about forecasting, some of the models for currency forecasting, some of the pitfalls that are involved as you take a look at currencies and try to guess what the values are going to be in the future. Our general argument is that it is very challenging to guess where a currency is going to be in the near term or in the longer term. We're going to talk a little bit about the challenges that this poses for companies, because we're going to see a large volume of currency forecasts. We're going to have a lot of different banks, a lot of different economists giving us their views of where they think the Canadian U.S. dollar currencies are going to be trading at in the for the foreseeable future. And when we're, as businesses, when we're taking a look and we're basing a lot of our currency management strategies on these forecasts, we're going to take a look at some of the risks that poses to our company. Don's focus is then going to turn over to currency hedging. He's going to talk a little bit about some of the benefits of hedging your currency exposures. And then we're going to take a very detailed look at some of the products that are available to address currency management issues. When we sat down and we kind of really started this, I focused on one side of the market, which is people that are buying U.S. dollars. It's sort of the happier side of the market right now. We appreciate that a lot of you here are probably involved in either different currency pairs. Maybe you're involved in the euro or the British pound or the Japanese yen. And a lot of you maybe are here and you are using the U.S. dollar, Canadian dollar currency pair, but in terms of your exposure, you're on the other side of the market. You have U.S. dollar receivables, you're selling U.S. dollars to buy Canadian dollars. When Don runs through the products, we are going to be focusing on that buy side of the market, but just rest assured that all of the products that we're talking about tonight can be equally well applied to the other side of the market or across any number of different currency pairs. As I mentioned, when we look at the U.S. dollar and what's been happening in the U.S. dollar, one of the big drivers since really about last August or so has been this subprime credit crisis or subprime mortgage crisis. Just a little bit of background. This is something that's been talked about a fair bit lately. But when we're talking about subprime mortgage lending, what we're talking about is high loan-to-value mortgages being made to people with shaky credit histories and often no verifiable sources of income. So what's happened is this type of borrowing in the States has come to represent just a massive part of the U.S. housing market. 20 to 25% of the mortgages that were entered into from 2004 to 2006 fall into the category of subprime. And by 2006, about $600 billion of the U.S. Mortgage market would be categorized as subprime type mortgages. That's about 20% of the U.S. Total home loan market, as you can see there. The The basic principle of the whole subprime phenomena was simply this, that when you went out as a subprime borrower, as long as your house continued to rise in value, pretty much everything was okay. So what would happen is you would enter into an agreement to buy a property, maybe for $200,000, and when it came time to refinance your mortgage, as long as it was worth $250,000 or $300,000, then you could refinance your home, use some of the equity to expand on and things like that, and everything worked pretty well. Also, interest rates had to stay at very low levels. As we know, recently the U.S. has been hiking interest rates pretty aggressively up to about 5.25% prime rate. What happened was that we saw this large correction in the U.S. housing market. This happened really around last August. August of last year we had the first initial correction, and then again this August we had another significant slowdown in the U.S. housing market. Prices dropped substantially. At that point in time, about $1 trillion worth of mortgages were up for renewal, so they had to be refinanced, and interest rates were higher. And when it came time to renew these, the banks were looking at this risk, or the mortgage companies were looking at this risk and saying, well, you don't really qualify, to borrow this amount of money against a home that's only worth a fraction of what it was worth when we gave you the initial mortgage. So you started having these mortgage defaults just piling up. It was getting harder and harder for the housing market to sustain itself, and the prices just continued to correct downwards. In and of itself, I think this is a pretty normal phenomenon. You have a period where housing prices do rise, typically fairly dramatically, and then they peak out and they do fall a little bit, and you do have mortgage defaults that kind of go hand in hand with that. The economy slows down a little bit, things correct towards normal, and then it starts up again as a cycle. What's really made it different this time around is the way that a lot of these mortgages were collateralized, or the way that they were financed. And I think with any of these financial crises, it's kind of the things that pass into the common parlance that become, so interesting. So you start hearing about concepts like asset-backed commercial paper or collateralized debt obligations. These are the instruments that these smaller mortgage companies or mortgage finance companies were using to secure capital from the market. So what they were doing is mortgage companies were going out and they were floating what's called commercial paper. And these are just basically short-term borrowing arrangements. If you're a company like GE, you can do that basically on your name value. So you go out there and you borrow $100 million, you float $100 million of commercial paper. Somebody buys that commercial paper and GE pays them some interest for it. They use the money that they've earned for that commercial paper to finance lending arrangements and stuff like that. With the smaller mortgage companies that were entering into this, they had to provide what's called asset-backed commercial paper, which are simply instruments that are collateralized with these high loan-to-value mortgages, car loans, credit card debt, things along those lines. Confusing things a little bit more is the way that these things kind of get split up. But for every one of these credit arrangements, there were portions of it that were very good, AAA rated debt. There were portions of it that were B-rated or AA to BB rated debt, and then there were some portions of that that were just completely unrated. These all get packaged together and then sold in the secondary market. And like I say, as long as the housing market continues to accelerate and people continue to make their mortgage payments, everything's fine. But as we know, what ended up happening is the housing market, the bottom really did fall out of it. So the mortgages start getting reset, people start defaulting on it, and the mortgage companies that are going out saying, well, we need some capital to increase borrowing or to maintain our borrowing levels, all of a sudden the capital market or the equity that was flowing into that before is no longer available. And you have a little bit of a credit squeeze or a liquidity squeeze. All of a sudden there's no money being reinjected into the capital system, and people start to worry a little bit about their investments, how protected they are, and things along those lines. So what's happened in the States basically is this has spilled over into other markets. People start getting worried about the scope of their investments, and the banks start looking at these and saying, well, the hedge funds that own these start saying, well, we don't really know what these instruments are actually worth in today's market, and they start trying to figure out a way to continue to raise the capital they need to sustain themselves. The banks that had guaranteed or had pledged to stand behind these assets all of a sudden stopped providing liquidity. There's no short-term borrowing that's really available in the market, and what happened is the central banks have to now step in and start providing liquidity to the market. So we saw that in August and early September, central banks putting billions and billions of dollars into the markets just to keep a credit market alive and vibrant in the United States. The risk from here, I mean, obviously things have cooled off a little bit as of later. It's not quite as dynamic a topic as it was 2 weeks ago or so. But the risk as we kind of look forward is this, that at this point in time we still don't know what the full scope of this is going to be. There could be a lot more defaults on mortgages. The housing market could continue to collapse. Just recently we had Alan Greenspan come out and say that he expects the U.S. housing market to contract by as much as an additional 20%. And he expects that there's going to be a lot of defaults on mortgages. If this happens, then you're going to have situations where a lot of the people that have invested in this type of commercial paper are not going to want to, continue to invest in this market, and there's not going to be a lot of capital available, short term for the credit markets. That can have an effect where it contracts the entire economy. So it spills over. Central banks can't provide enough liquidity. There's no capital available for businesses to borrow, expand, and develop their operations. We've seen some pretty significant corrections, though, in a lot of the markets on the back of this. It could also really all blow away. I mean, if the housing market doesn't correct by as much as, as is concerned, and the defaults don't pile up as much as they could, then it's possible that eventually the markets will return to normal. But in terms of a pitfall for the U.S. dollar, I mean, this is really a real trap as we look ahead, into 2008. If there is a massive type of correction, the U.S. dollar could conceivably collapse in value even further. It's already down significantly against a lot of currencies. If it turns out to be a non-event, you may see the U.S. dollar come back as investor confidence returns to the U.S. dollar. We've seen the housing starts, like I mentioned, have fallen off, and the forecast is that housing sales will continue to slide in the United States. Another interesting thing about this whole phenomenon is the way that American consumers or American household owners were using their mortgages to raise equity for other purposes. So to buy a car, to pay for college, to maybe add on to their homes, buy another property, things on those lines. Americans were basically using their homes as giant ATMs, taking cash out of them, refinancing them with instruments that allowed them to maintain very low payments. About 70% of the U.S.'s GDP growth can be tied to the housing sector in some capacity for the last couple of years. So if just that aspect of it dries up, U.S. GDP growth could be challenged, and it could be very difficult, for the U.S. economy to continue to expand at the level rates that it has been. Okay. I know that's kind of a convoluted thing to kind of deal with, but that's the subprime crisis kind of in a nutshell. Like I say, it is still a bomb that's out there for the U.S. economy, or potential bomb that's out there for the U.S. economy. On a lighter side of things for the U.S., sorry, did I mention it way ahead of myself? Just to deal with some of the U.S. economic indicators that we've seen as of late, and these are a little bit more rosy than they have been in a little bit more robust. Overall, U.S. growth figures are pretty solid. They're not stellar by any stretch, but overall, we look at the U.S. and say that the economy is still doing fairly well. You can see here that GDP growth has been fairly stable, a little bit of dips and valleys along the way, but maintaining itself at about that 3% level, that's consistent with about the 10-year prime for that. Employment growth has been decent in the United States. There's been some decent job creation. We've had about 3-4 years of consistent job creation. That ended just last August in the United States when, for the first time in about 3-4 years, the U.S. did post negative employment growth, so a little bit of a slowdown in that capacity there. See, the employment rate again has been trading very low. Historically 4.6, 4.4% band. In the last little while, it's a very good unemployment rate, but it is expected to tick up just a little bit as we look ahead. Interest rates, we talked about this a little bit, but the U.S. Federal Reserve had hiked interest rates to about 5.25%. All the expectations leading up to about August of this year that the U.S. would continue to hike interest rates a little bit as they were combating inflation. Instead, the subprime crisis reared its head, and the U.S. was forced to start cutting their interest rates. On a September session, 2 weeks back or so, the U.S. Federal Reserve met and decided to cut interest rates, the Fed funds rate by 50 basis points, a little bit more aggressively than most people were expected. And that led to some shake-up in the currency markets. That was the day, or the night following that was the day that the Canadian dollar hit parity with the US dollar. In terms of the Canadian dollar, we've highlighted kind of two main things that have helped support the Canadian dollar over the past couple of years, 2-3 years or so. And they kind of run together to a degree. But we look at commodity prices, the trend of rising commodity prices. Canada is very rich, of course, in commodities, and the amount of foreign-led acquisitions of Canadian companies is kind of key. To take a look back, crude oil, I mean, it's no secret that Canada is one of the world's largest producers of crude oil. Canada, a lot of people suggest, has potential to be the second largest producer of crude oil in the world, behind only Saudi Arabia. Some people suggest that, in fact, our reserves are even greater than that, and we could be the largest producer of crude oil that's in the world. Natural gas as well. And what you'll see here is that prices have risen substantially. We're aware of this when we fill up our cars at the pumps, but crude oil topped $80 a barrel. Some forecasts have it going as high as $100 a barrel. For Canada, I mean, that's just a tremendous benefit. I mean, this is a resource that we are incredibly rich in, and it's in demand. So when you look at emerging economies, when you look at China, when you look at India, the demand for this type of commodity is just off the charts. That type of demand should keep the commodity well supported, and the Canadian dollar as a petrocurrency very well supported as well. Again, other commodities that Canada is rich in, commodities like gold, we've seen it recently appreciate over $700 an ounce. And just to show that we're not all about metals, wheat, which Canada also produces, an abundance, one of the world's largest producers of wheat, has been accelerating quite a bit lately in terms of its value as well. When you take a step back and kind of look at Canada and its commodity base, it's no surprise that because we produce so much of the primary resources that the world needs, that there has been a lot of interest in the Canadian economy and in a lot of these commodities. What this has fueled has been a lot of acquisitions, foreign-led acquisitions of Canadian companies. They tie together a fair bit because a lot of the Canadian companies that have been the subject of these foreign takeovers have been a lot of our primary resource producers. Just to give you some of the high-level numbers, though, last year, 2006, $105.5 billion worth of Canadian companies were acquired by foreign entities. The first 7 months of 2007 alone, $154.8 billion worth of Canadian companies have been acquired from entities outside of Canada. From 2001 to 2006, 455 Canadian companies were bought by foreign firms for $137 billion, and since 1985, $705 billion of Canadian companies were acquired by foreign entities. When you look at this list of the names, and these are the ones that have happened in 2006 or early 2007, you see them: Alcan, Inco, Western Oil Sands. These are massive commodity producers, so companies that are dealing in these primary resources. What's happening is a lot of foreign entities that require the resource are electing to buy the source. Why are they doing that? Well, Canada's a good, stable economy. It's a good place to invest in. It's a good place to own a subsidiary in to begin with. We have a nice, stable economy. We have a tax system that's very supportive of this type of foreign-led acquisition. And when you look at Canada in terms of especially its oil and other resources along those lines, it's a very naturally safe market to be in. You don't hear about hurricanes disrupting Calgary oil supplies. You don't hear about pipelines, being disrupted by terrorist activities like you do in some of the other key oil-producing parts of the world, whether that's Mexico, whether that's Venezuela, or particularly some of the main centers in the Middle East. So again, just to kind of step back from that, what we've got here is this picture that the U.S. has been under pressure for the last few years, and as of late, a lot of the pressure has come from the subprime issue. Canada, commodity prices have been rising, M&As have been rising, pulling foreign investment into Canada, and that's been supporting the Canadian currency. So just to take a look at kind of some of the comparative economics for U.S. and Canada, I think we kind of are aware of this on a high level. The U.S. GDP is valued at about $13.5 trillion. Canada, about 10% of that at $1.3 trillion. Our GDP per capita is lower. Our GDP growth rate is around the same as the U.S., but has a lot to do with the fact that our economies are tied so closely together. Personal disposable income is higher in the United States, and unemployment rate, while higher in Canada, both countries boast incredibly attractive unemployment rates. Job creation, we've seen this as of late. Canadian job creation was particularly powerful at the start of the year. A lot of those jobs, of course, were created in Western Canada, Alberta. When you start stripping Alberta growth out of the markets, it starts to look a little bit different. Very well documented, the U.S. was a job-creating machine towards the start of this year. When you take the average job creation so far in 2007, both are sitting around their typical historical averages. So the U.S., that's about 112,000 jobs getting created a month, and for Canada, that's about 15,000 jobs, give or take, getting created a month. Balance of trade. U.S. has been running this massive trade deficit. What is it, $60 billion. I think the world's become pretty comfortable with this as kind of a reality. The U.S. has a lot of imports more than it exports, just astronomically. Canada, the only country in the G7 that does run a trade surplus. Again, it's a fairly stable one at about $5 billion, give or take. When we look at kind of the currency markets now and step back and kind of look at what's been going on, we're going to look at the U.S. dollar just in terms of the U.S. dollar index. What the U.S. dollar index is just a trade-weighted value of the U.S. dollar against a basket of currencies. The baseline for this was in 1973, so you took the U.S. dollar, assigned a percentage to all these different currencies that it traded against its key trading partners, and you ended up with a value, and that was a value of 100. So with a value of 100, what that means is that if the U.S. index, the dollar index, is at 120, then the U.S. dollar has experienced about a 20% appreciation in value. If it's at 80, then it's experienced about a 20% decline in value from its baseline. And we look at this timeline going back to about 1999, and what we see is that period of time when the U.S. dollar was rising pretty steadily against most currencies. This was the peak of the U.S. Strong dollar policy, when the U.S. wanted its currency to be strong. And that topped out in about 2001, 2002. Ever since then, 2003 on, the U.S. dollar has been in a protracted slide against most currencies. And we've seen this range anywhere from 60%, when you're looking at the Canadian dollar, the euro, to 30, 40% for most currencies. But universally, almost all currencies are stronger against the U.S. dollar today than they were in 2002 or 2003. And in most cases, they're alarmingly or dramatically stronger than they were then. Look at the dollar index over the last couple of years, and we see that this trend has continued. The U.S. dollar continues to fall off in value pretty sharply. Over the last just year or so, when we take a look at what's been happening with currencies, again, the trend has continued. Currencies appreciating against the U.S. dollar. So this is looking from last September to this September now. And we see all these currencies, the euro, the British pound, Swiss franc, the Japanese yen shown here, have all increased in value against the U.S. dollars. There's been some corrections on this chart. You see the Japanese yen spent some time weaker against the U.S. dollar than it was in September. But for the most part, where we stand now, currencies are strong against the U.S. dollar. And the more commodity-based ones, euro just thrown in there again as a baseline. But the Australian dollar, the Canadian dollar, the New Zealand dollar, again, all stronger against the U.S. dollar. We had that period of time, January, February or so this year, when the Canadian dollar did weaken off, 118.85 or so. But since then, the Canadian dollar has been on a pretty dramatic run, gaining against the U.S. dollar. To put it in perspective, from January 1st to where we stand now, the Canadian dollar has been the largest gainer in the currency markets worldwide. It's up about 19% against the U.S. dollar year to date. You see there the euro has slowed down a little bit, some 10%, and the other currencies that are shown there have not gained as dramatically against the U.S. dollar this year as the Canadian dollar has. I think when people look at that, 18% or so that's occurred this year, we look at it as something that's very dramatic or something that's very unusual. But in reality, the last few years, you'll see here we've had that type of volatility in the currency pair. What this shows is the average change, high to low, for the currencies since 2003. The Canadian dollar appreciated even more in 2003 against the U.S. dollar than it has this year, having a 22.6% gain. 20% gain, or just about a 20% gain in 2004. The last 2 years, 2005, 2006, have been a little bit more quiet, just 11% and 7.8% gains. And now this year we have this 19% gain in value for the Canadian dollar. Again, though, all those currencies have gained against the U.S. dollar. over that period of time pretty steadily. When we look at the 10-year chart for the Canadian dollar, we see that peak in January of 2002, when the Canadian dollar was trading at 161.14 or so to the U.S. dollar, and almost right after that, the currency markets did drop off substantially. That big move in 2003, the 23% gain for the Canadian dollar, and a trend that's continued and taken us all the way to parity where we stand now. In a little bit closer, the 5-year chart, again, just that steady appreciation against the U.S. dollar, not very many pullbacks in there along the way. The 1-year chart, again, that dramatic move that we've seen since March of this year or so, it's taken us down to parity again. Really not much of a break, just a one-way slide all the way down. And even the 1-month chart, from where the Fed cut interest rates, another 4 or 5% drop, sharp drop in value for the U.S. dollar appreciation for the Canadian dollar. We are going to be stopping for dinner pretty soon. Just to kind of take a look back, I think when you kind of try to put this in perspective, since 2003, the decline in value for the U.S. dollar has been about as broad-based as can occur in a currency. I mean, I say 60-odd percent from high to low for the Canadian dollar, similar for the euro. All these currencies dramatically more value for the U.S. dollar. And we kind of look at that and we say, well, does this mean that the U.S. dollar is now undervalued, or does it mean that it's appropriately valued? Well, it's really very challenging to say, what that really means in terms of the currency sense. It's possible that in 2002, 2003, the U.S. dollar was overvalued, and definitely the index value at 120, may support that. Similarly speaking, now, 40% lower or so, one might be able to conclude that the U.S. dollar is undervalued against a lot of currencies. But I think it's an interesting perspective, now that we're sitting here at parity, 1-to-1 with the U.S. dollar. And to kind of think back over, my time in the foreign exchange markets, and talking to clients when we were at $1.60 in the U.S. dollar. When $1 US would get you $1.60, and all of the exporters to the U.S. market were ecstatic. And what happened is at that point in time, everybody was under the impression that, hey, the U.S. dollar was going to continue to appreciate against the Canadian dollar. A lot of the economists, that now are predicting that the U.S. dollar is going to fall off even further in value. At that point in time, a lot of them were predicting that we would actually hit a point where the U.S. dollar would buy 2 Canadian dollars. So those are some pretty dramatic predictions that were made at that point in time. And what happened is a lot of the people that were sellers of U.S. dollars became complacent. So as a lot of businesses in Canada were counting on the fact that the U.S. dollar was going to continue to be strong, and their exports to the U.S. were going to continue to fetch more and more Canadian dollars locally. Productivity did decline a little bit in line with that. Canadian productivity is still lower than U.S. productivity. But the main thing I think that happened is that we became so used to this phenomenon of $1.60, or potentially even more. A lot of companies just were able to neglect the currency concern. People that were buying U.S. dollars knew that they were going to pay a lot for the U.S. dollars. But most Canadian companies, of course, are exporters to the United States, and were reaping massive benefits, and just said, well, it's going to be like this forever. Instead, what have we seen? Well, we've seen this dramatic slide. Here we are, parity today, 65% lower, 61% lower than we were in 2003. And this is the kind of move that a lot of exporters to the United States market have absorbed. Now, this has demanded a lot of repricing of the value of a lot of their products that they're selling in the United States. It's led to a lot of hits in terms of overall profitability. It's led to a lot of defaults for some Canadian companies that were highly reliant on that stronger U.S. dollar. When we're sitting here at parity now, and the same arguments are piling up, well, the U.S. dollar is going to be this weak forever, or it's going to get even weaker from here, and we're looking at, as an opportunity, what can we do? Here we are at parity. What does it mean if you're a buyer of U.S. dollars? Should you be doing something to secure this rate of exchange, long-term, moving forward, or should you continue to ride this wave, this more favorable wave? I think that's the main thing, is just to keep that in mind, that when you get to the very extreme end of a currency move, there's not going to be anyone that's going to ring a bell and tell you, this is it, this is as far as it's going, and from here it's going to move back the other way. Currencies can move dramatically, and sometimes the events that cause things to turn around are so subtle that we kind of miss them, and we end up just kind of sitting on the sidelines saying again, what happened? How did we get where we're at? Don's going to take us through in a little bit some of the tools that we can use to capitalize for those of us that are buyers of U.S. dollars on the strong Canadian dollar. For people that are still selling to the U.S. market, of course, he's also going to touch a little bit about the fact that there is still some risk and the fact that the Canadian dollar could continue to gain in value, the U.S. dollar could continue to decline. I don't want to keep anybody else much longer from dinner. I want to thank you for your time, and if there's any questions, I'm happy to try to answer.
Okay, just relax. This is supposed to be relaxed atmosphere. Just relax. Food is coming out soon. So, for the benefit of Ian and Don's Travex, maybe while waiting for the food to come out, maybe we'll take on Alan. How many billion dollars you need? How many billion?
Is this working?
It's working.
I do have a question, by the way.
Yes, go ahead.
I know everybody talks about the long term. That's a reality, and you cannot really deny it. But in the short term, in like the next 3 years, if I'm telling you tomorrow they're moving to New York, what would you do in terms of investment? Do you invest in U.S. real estate, or you would just stay in Canada and stay in Canada in the short term? And say short term, I put a 3 years horizon. The reason is we are a public company, we talk about long term, but the market is not too patient with what we talk about long term, and no one cares about long term. As I said, the reason why we don't care about long term is because none of us will care in the long term. But you talk about 3 years horizon, what's the advice on the currency market, U.S., Canadian?
From an investment perspective, I would not invest in U.S. subprime mortgages right now. I think it's an interesting point that you make, and a lot of the companies that we're talking to that have been exporting to the U.S. and have been in a situation where they're no longer realizing the dramatic values of Canadian dollars for the U.S. receivables. They're taking a look at the U.S. economy and what's available in the U.S. now and what they can do with the U.S. dollars as an alternative. And a lot of Canadian businesses are talking about ways to expand their cost base into U.S. dollars to get a more balanced approach. Whether that's to open up a facility in the United States or to expand trading relationships, supply chains into the U.S. market. A lot of it is just trying to find those natural ways to make use of their U.S. dollars. Because in the United States, a dollar is worth a dollar. Just like in Canada, Canadian dollar is worth a Canadian dollar. It's only really when you leave your country that the currency value really does matter. In terms of the short-term view for the currencies, I mean, 2003, I think, just kind of really